Have you ever wondered how you could diversify your portfolio beyond traditional stocks, bonds, or real estate? Welcome to the fascinating world of alternative investments. In the ever-evolving landscape of finance, savvy investors are constantly seeking new avenues to grow their wealth. They're looking beyond the conventional, beyond what's been tried and tested. And that's where alternative investments come into play. Alternative investments are essentially financial assets that do not fall into the traditional categories of stocks, bonds, or cash. They're the road less traveled in the world of finance, a thrilling detour from the beaten path, and they're gaining popularity fast. But why, you may ask? Well, it's because they offer a unique combination of potential benefits. They can provide diversification, which is essentially a way to spread your eggs across multiple baskets, reducing risk. They can also offer higher returns, albeit often with higher risk. And they can act as a hedge against inflation, a shield to protect your wealth when the economy gets stormy. But what's truly captivating about alternative investments is their variety. They encompass a vast and diverse range of assets, each with its own unique appeal. There's the classic allure of precious metals, the shimmering promise of gold and silver. There's the aesthetic appeal of art, the thrill of owning a piece of history or culture. There's the refined taste of wine, the pleasure of savoring a liquid asset, and then there's the cutting-edge excitement of digital assets, the allure of riding the wave of technological innovation. And that's just the tip of the iceberg. The world of alternative investments is vast and varied, filled with intriguing opportunities and fascinating potential. It's a world that invites exploration, that rewards curiosity with potential riches. So are you ready to venture beyond the familiar, to explore new horizons and unearth hidden treasures? Let's delve into our first alternative investment, precious metals. Why are they considered a safe haven? The glimmer of gold, the shine of silver, the allure of platinum, precious metals have historically been a safe bet during economic downturns. When it comes to alternative investments, precious metals are often considered the stalwarts, the old reliable. They've been a beacon of stability in stormy financial seas for centuries. But why? What makes them such a safe haven? Well, for starters, precious metals like gold, silver, and platinum are tangible assets. They're physical, you can hold them in your hand, and there's a certain comfort that comes with that. They're not just numbers on a screen or a piece of paper that could become worthless overnight. The value of precious metals doesn't depend on a company's performance or a government's fiscal policy. They've got intrinsic value, driven by supply and demand. And here's the kicker, they're finite. There's only so much gold or silver or platinum in the world. This rarity, this limited supply, it's part of what drives their value. Historically, precious metals have shown strong performance during economic downturns. When other asset classes like stocks and bonds are in turmoil, investors often flock to gold and silver as a safe harbor. And it's not just about protecting wealth. Precious metals can also be a powerful tool for growth. Consider this, during the financial crisis of 2008, gold prices surged by over 20%. Silver, not to be outdone, saw an impressive 50% rise in the following 2 years. And platinum? It's consistently held its own, proving to be a solid performer. But it's not just about crisis management. Precious metals can also act as a hedge against inflation. As the cost of living rises, so too does the price of gold and silver. So while your paper money is losing purchasing power, your precious metals are holding strong, maybe even growing. So whether you're looking to protect your wealth, grow your portfolio, or just like the idea of owning something shiny, precious metals offer a compelling case as a safe haven investment. But if metals don't pique your interest, how about owning a Picasso or a Warhol? Imagine having a masterpiece hanging in your living room that also serves as a lucrative investment. Art, in its many forms, has long been a source of enjoyment and inspiration. But did you know that it can also be a successful investment strategy? Investing in art brings together the best of both worlds, the pleasure of owning a piece of history and the potential for substantial financial returns. The art market has seen tremendous growth over the last few decades. According to a report by Art Basel and UBS, global sales for art reached an estimated $64 billion in 2021, a significant increase from the previous year. This indicates that despite economic downturns and uncertainties, art as an asset class has managed to hold its own, even outpacing traditional investment avenues like the S&P 500 in certain years. However, like any investment, purchasing art comes with its own set of risks. For starters, the art market can be quite opaque, with prices often driven by subjective factors such as taste, rarity, and the artist's reputation. There's also the risk of forgeries, which can be difficult to detect without expert knowledge. Moreover, art isn't a liquid asset. It can take a considerable amount of time to sell a piece of art, particularly if it's a high-value item. This is why experts often suggest that art should be part of a diversified investment portfolio, rather than being the sole focus. Yet, despite these challenges, investing in art can be incredibly rewarding. Not only can it provide potential financial returns, but it also offers the unique joy of owning a piece of cultural heritage. After all, there's a certain satisfaction that comes from seeing a beautiful painting on your wall and knowing that it's not just a piece of decoration, but also a wise financial decision. Indeed, art investing is not just about money, it's about passion, knowledge, and the thrill of owning something truly unique. From visual art to the art of the vine, let's explore the world of fine wine investing. For those with a refined palate and a penchant for luxury, investing in fine wines can be a fruitful endeavor. But what makes wine such an attractive investment? Well, it's a classic case of supply and demand. As the years pass, wine matures and becomes more valuable. At the same time, the supply of these aged bottles dwindles as they are consumed, further driving up their price. Consider the story of a bottle of Chateau Lafite Rothschild from the 1982 vintage. Purchased in the mid-80s for just about $25, it's now worth upwards of $4,000. That's a return of nearly 16,000%. But it's not just about the monetary gain. Investing in wine can also be a deeply satisfying pursuit, allowing you to combine a personal passion with a strategic investment. However, as with any investment, there are risks involved. One of the main threats in the wine market is the existence of counterfeit bottles. These fake wines can look convincingly real, fooling even the most discerning of collectors. It's essential to buy from reputable sources and, in some cases, to seek expert advice to ensure the authenticity of your investment. Another risk to keep in mind is the cost of storage. Fine wines need to be stored in ideal conditions to maintain their quality and, therefore, their value. This often means renting a professional wine storage facility, which can eat into your profits. In addition, the wine market can be unpredictable. While some bottles appreciate significantly over time, others may not perform as expected. It's crucial to diversify your wine portfolio, much like you would with stocks or bonds, to mitigate these risks. Ultimately, investing in wine is about much more than just making money. It's about the thrill of the hunt, the joy of discovery, and the satisfaction of owning a piece of history. If traditional investments don't quench your thirst, perhaps the digital world holds your fortune. In the digital age, even investments have gone virtual. Welcome to the realm of digital assets. Just as the internet has transformed the way we work, communicate, and entertain ourselves, it's also revolutionizing the world of investing. Digital assets like cryptocurrencies and non-fungible tokens, or NFTs, are leading this charge. Cryptocurrencies, the digital gold of the 21st century, have captured the attention of savvy investors worldwide. Bitcoin, Ethereum, and the ever-growing list of altcoins offer the potential for staggering returns. Consider Bitcoin's meteoric rise from mere pennies to tens of thousands of dollars in just over a decade. It's a digital gold rush, and many are staking their claim. Yet, like the gold rushes of old, this new frontier of investing is not without its risks. Cryptocurrencies are notoriously volatile. Prices can skyrocket or plummet in the blink of an eye. This volatility isn't for the faint of heart, but for those willing to ride the roller coaster, the potential rewards can be immense. But cryptocurrencies aren't the only digital assets making waves. The world of art and collectibles has also entered the digital sphere with non-fungible tokens, or NFTs. These digital assets represent ownership of a unique item or piece of content. From digital artwork to virtual real estate, NFTs offer a new way to own and invest in unique assets. The appeal of NFTs lies in their uniqueness and the blockchain technology that underpins them. Each NFT is one of a kind, and the blockchain ensures the ownership and authenticity of these digital assets. However, as with cryptocurrencies, NFTs are highly speculative and risky. Prices can fluctuate wildly, and the market is still in its infancy. The world of digital assets is exciting and full of potential. It's a brave new world of investing, offering opportunities for high returns, but it's also a world of volatility and risk. As with any form of investing, it's essential to do your research, understand the market, and invest wisely. Alternative investments present a world of opportunity, but as with any investment, due diligence is key.